Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates, and this is our weekly market update for the week of December 23rd. Thank you for joining us this week. If you're new, hopefully you find this information helpful, and if you're a regular, don't forget you can always throw questions in the comments, and I'll do my best to get back to you. With that said, our purpose for these videos, as always, is to try to use my background in economics to help explain the economic reports and the changes in the financial markets so that you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. Our big topic from last week was the interest rate decision coming out of the Federal Reserve. The Federal Open Market Committee decided to reduce interest rates by 25 basis points, which wasn't a big surprise to anyone. This is what the markets and the analysts had both expected. But what was a big surprise was that the Open Market Committee released their summary of economic projections, which actually showed a pretty significant increased projection for inflation over the next 3 years. Overall, the economic projections showed a relatively stable unemployment rate of about 4.2% for the next couple of years, showed a relatively healthy economic growth rate, with real GDP growing between 2 and 3% for the next couple of years. But it also showed a much slower decrease in inflation towards the Fed's 2% goal. Some folks felt that this increased inflation estimate was a result of political bias and was maybe directed at the inflationary policies of the incoming Trump administration. Some folks felt that cutting interest rates when the projection forecast longer, more resurgent inflation was irresponsible. And some folks felt that in previous Federal Reserve meetings, there had been a strong emphasis on the labor market and how it was slowing down. And so concern was raised because the labor market seemed to be an afterthought given the new increased concerns with inflation. Following the release of the economic projections, we saw a massive response from the financial markets. We saw all three stock indices lose at least 2% by the end of the day. We also saw the NASDAQ and the small cap stocks lose almost 4% by the end of the day. We saw the value of the dollar skyrocket. We saw gold and Bitcoin both dramatically drop in price. And we saw a massive sell-off in the fixed income government treasuries markets. The result of the sell-off in the treasury markets, we saw 2-year, 10-year, and 30-year treasury yields increase by a significant margin relative to the movement in recent days. The combination of estimated higher interest rates for longer, resurgent inflation, and potential conflict between the Fed and the incoming Trump administration all contributed to a significant increase in both fear and concern and volatility in the financial markets, demonstrated by the VIX, which is our volatility index, increasing from 15 to 24. We also saw some inflation and some gross domestic product data released later in the week. Fortunately, the personal consumption expenditures, or PCE price index, gave us some positive news as the month-over-month inflation rate actually decreased from the previous month, although the 12-month year-over-year inflation rate remained about the same as it has for the last few months. As far as gross domestic product, we saw the final estimate for the third quarter GDP, which actually came in significantly higher than the previous two estimates. Previously, we had estimated that the economy had grown at about 2.8% in the third quarter, and this final third estimate demonstrated that the actual growth was closer to 3.1%. We also saw data coming out of the Conference Board, specifically the leading economic indicator index, which helps us to understand where the economy may be headed in the future. Unfortunately, we saw the first increase in this index since February of 2022. Also, on a positive note, we saw retail sales come in significantly higher than expectations for the month of November. We saw home builder enthusiasm continue for the future of the housing market, and we saw existing home sales beat expectations. The stock market ended significantly lower at the end of last week, mostly because of the sell-off on Wednesday. But one important note to mention is that the Dow Jones Industrial Average was able to snap an 11-day losing streak on Thursday. Although just barely registering a positive result, it was the end of the longest streak of losing days for the Dow Jones Industrial Average in the last 50 years. Fortunately, the markets seem to have recovered from the Wednesday sell-off with a significantly positive Friday result. And the big question is what this week has in store for financial markets, especially around the shortened holiday trading dates. The yield on the 10-year Treasury took off the end of last week, closing at approximately 4.5%. The big sell-off on Wednesday included a big bond sell-off, which pushed up yields on the 2, the 10, and the 30-year Treasury. And in fact, the change in the Treasury market around the middle of last week actually resulted in pushing up the yield curve. So we now have less of a U-shaped yield curve and more of a traditional upward sloping yield curve, where as the term on debt increases, the return or yield on that also increases. Last of all, of course, I have to mention Bitcoin, which crossed the $100,000 mark again. Unfortunately, this time it was on the way down. The Bitcoin market continues to remain volatile as we see big increases followed by big sell-offs, and last week was no exception. Following the information and the market sell-offs on Wednesday, the value of Bitcoin dropped significantly, although it did recover a little bit of that value, ending the week just below 100,000. Most of our attention in the last year has been on the presidential election, although last week was a stark reminder of the challenges that we face in the House of Representatives. The near-perfect 50-50 split between Democrats and Republicans, unfortunately again, led to a drawn-out, back-and-forth debate about the budget and what we refer to as continuing resolutions, which are temporary funding bills to propel the budget forwards. Fortunately, another last-minute deal passed through, and we were able to avoid another government shutdown. Unfortunately, the big question in the economy and the financial markets becomes how many of these showdowns and last-minute deals are our creditors and the credit bureaus willing to accept before they start to lose trust and faith in the ability of the U.S. government to pay its bills. In the past, we've seen these credit and budgetary showdowns result in a reduction in the U.S. government's credit rating, and there are already conversations among analysts and the creditors that this may occur one more time. Looking ahead to the rest of this week, we expect it to be relatively quiet. There aren't any major economic data drops, and the trading markets will be on a shortened holiday schedule. We will see some new information as far as new home sales, durable goods manufacturing, and our regular weekly unemployment insurance claims, but overall, it should be a relatively quiet week. As always, looking even further out into the future, our list from this week hasn't changed much from last week. We continue to look forward to the inauguration of the Trump administration, as well as their first 100 days. We continue to watch for the fourth quarter earnings reports, as well as 2024 earnings reports. And we continue to watch and anticipate the global economic reports that are typically released in January from the International Monetary Fund and from the World Bank. Before I sign off for the week, I want to wish everybody a happy holidays and good luck in the new year. I want to thank you for joining us for these early episodes of the Weekly Market Update. I think that we've changed and grown a lot over the year, and I'm excited to see what 2025 has in store for us. I know I say it every week, but if you enjoyed the content and you found it informative, make sure to like and subscribe below. Also, don't forget to check out some of the other great John G. Ullman content we've posted this year. And don't forget to come back and join us again next week. As always, we'll be focused on collecting the economic reports and all the financial data to help you stay informed and up to speed on the markets. Thank you for joining us, and have a great week.